Hello everyone, welcome to Thai Finance. Today we're going to talk about the elements that drive the market forces. And these are the main indicators that everyone should be aware to take investment decisions. So why the price of oil, the bond market, technology and real estate are affecting you directly. So if you want to know what is driving the economy at the moment, you should definitely watch this video. Today I'm going to give you some context of the economy first. The prices of equities fell sharply in the month of March and from previously overstretched levels. In credit markets, spreads skyrocketed, especially in risky segments that it's not supposed to be happening, such as high-yield bonds, leveraged loans, and private debt, where issuance essentially came to a halt. As well, oil prices, remember that, plummeted in the face of a weakening global demand and the failure of the OPEC countries to reach an agreement on output cuts, adding a further leg to the deterioration in risk appetite. This means that these volatile markets led to investors to seek for more risky assets and, of course, the high-yield safe haven assets like bonds and gold. The first element that I want to talk about is fiat currency. So the currency market is the largest market of all. And this depends on central banks, political situation, imports, exports, and underlying markets like oil and gas, electricity, the natural resources that each country has, like copper, gas, and also the geopolitical situation and so on. So it's a complex market, but it's the biggest one. And if one fiat currency is widely used, that country's government or people have significant advantages, and it's a privilege, to be honest. It's a gift for a country. In this case, the US dollar is the world reserve currency, right? So they can increase deficit spending by issuing more currency and pay for more goods by leveraging their economies. Let's say one country that has a currency that is widely used, they can do that. And right now the US dollar is the world's reserve currency, and it's tied to financial markets and as well oil. This is very powerful currency because it's so convenient today to use US dollars. So it's widely used to exchange dollars in the financial markets that are really the market movers of our economy, because there's just lots of fiat currency inside the financial markets. The average people, basically, they don't have any idea of how much money there is in the financial market. As well, it is widely used for international commerce. Commodities like oil are purchased in US dollars, which is another market mover. And most important, people trust the US dollar. Here we have the US dollar currency index, which is how we measure the dollar against other important currencies like the British pound, the yen, the euro. As you can see, there is like a sharp decline from the 1980s to the present, and it might continue to fall. There are no signs right now that they're going to get more powerful. So there's a decline in the US dollar currency market. The country is getting weaker. I'm going to give you an idea of how currencies have lost their value throughout time against the US dollar. So we can see here the performance of different currencies from the beginning of the year to the actual date. So we can see other currencies against the US dollar sharply declining and losing performance. And because of this, the US dollar demand has increased sharply at the beginning of the year, and then the opposite happened. We can see a significant decline of the Brazilian real, for example, or the Mexican peso and the rubles, right? This is something that it's not good, because there's like lots of volatility, lots of currency stability, and basically people are losing value by having cash. So this is leading people to invest in more risky assets. So the oil market is tied to the US dollar. Obviously, the big international transactions are used in dollar, and recently the euro is used as well. Why the oil is so attached to the dollar? Because basically everything is made out of oil. If you walk through your house, all the plastic that you have, all your toothpaste, your medicines, some of your clothing is made from oil. So of course, if everything is paid, all the international transactions of oil are paid in US dollar, it's a world reserve currency. It's widely used. It is very tied to the US dollar. Surprisingly, at the beginning of this year, oil prices went to zero, went to negative, and it was a big change in the geopolitical and international arena because this was a big shot to the US dollar as a reserve currency. And we don't know if that shot killed the US dollar or it's just a deep wound, another deep wound. Maybe we're looking at the USD funeral and institutions are fighting for the testament, or the currency demand will make it stronger after this incident because we saw that the other currencies fell sharply as well against it. So it's interesting. We should be very aware of the price of oil, and this is one of the elements that really drives the economy. So never underestimate the price of oil in your daily life. Of course, if you have US dollars or other currencies, the price of oil it's significant, affecting you. So another market that really affects you directly, even though the average people doesn't exchange bonds in their daily life. But this is the market that knows all. Basically, it's the bond market, the 20 or 30 year bond market basically gives you a lot of information of what's going on in the economy. Bonds are exchanged mostly by institutions like big banks or hedge funds, countries, or maybe the same billionaires. Billionaires are aware of this bond market because they can move the market, and this is safe haven asset. People like Bill Gates, Jeff Bezos, or Warren Buffett are aware of the bond market. Recently, there is a crack between the bond market and the stock market. The direction that is taking the stock market and the bond market is to the upside, and they should go in opposite directions. Inflation started to kick in the recent month, and the bond market went to the downside. Or the stock market that is going up, or this one that is going up as well, one of them should be wrong. When both are going up, it means that something is really wrong. That's why there is like a divorce between the real economy and the financial economy, which is the stock market. Like there's like lots of jobless claims, an immense amount of bankruptcies. But if you invest when bonds go to the downside, that means that inflation is present. But when they go to the upside, that means that there is deflation. Central banks around the world are issuing more currency than they should. And their goal is to stabilize prices so people recover their income. But the debasement of the currency is making people to invest in other assets. That's why the stock market is going up. So here we can see that there's like a huge quarterly drop, maybe one of the sharpest in the last 50 years. And we can see that when the bond market went down so sharply, that means that there's no longer trust in buying bonds. At the beginning of the year, the economy slowed down. Deflation started to kick in, affecting prices. When there's deflation, there's like a drop in demand. Let's say that people stop demanding for stuff. And that causes a fall in prices. Okay, so when there's a fall in prices, there is a fall on people's revenues, because if you were selling, let's say, 3 apples at $10 and there is a sharp fall in prices, well, your revenue gets affected. That's that's why the Federal Reserve is so interested in keeping inflation and stabilize the prices. And of course, when there's like a fall in prices, there's like a fall in revenue. There's as a result, companies tend to reduce wages or cut people, and there is no net income because of this. There's no profit, and when there's no profit, there's no investments. So debts default, and of course there are more bankruptcies, job losses, and because of that there's also less taxes collected by the government. Of course there's like a lot of political turmoil, uncertainty, and of course volatility. And politicians want inflation because a falling prices represent a falling revenue for the government. And let's not forget that one people's income are other people's liabilities. So in the month of March, this was a sharp fall that basically increased volatility in all the markets. And because of that, the prices of bonds went to the upside. But now the inflation is kicking in. So when there's like the bonds going down, that means that there's some inflation going on in the economy. There's a huge business in the bond market. Actually, there's like even a business model for the bond market. Let's say in 2008, there was Europe wanted to prevent Greece to go bankrupt at all costs. At that moment, there were two types of bonds. One under the international law or English law, and the other one under the regional law. So these two types of bonds, the one with the national law, the government is able to default on that payment because they are sovereign, and that's it. But under the international law, there's like a meeting of creditors and the holders of that bond, especially the majority of holders, the ones that hold 70% or more, they get to vote, and they can basically decide if you pay or if that is negotiable. Not, but the thing is that some big institutions like banks, they say like, okay, if you won't pay, I blow things up and you go bankrupt. So there was a business model of banks and hedge funds. They can strategically decide which ones to buy. They can decide whether to are the profitable ones and the ones with international law, and you can filter everything. So they had all that information. And of course, profitability and voting rights are the main drivers to get them and to make a business model. So there is an enormous potential today for financial profits in the euro collapse, for example. That is today's world. And as you can see, some people are really interested and they're basically going against the euro. Of course, the key countries to collapse in the short term are Greece, Italy, Spain, and when this hits to France, well, something big is gonna happen. There's a significant deterioration in the social structure in these countries. For example, in Spain, there are lots of taxes, there are separatist movements. In France, there's immigration and as well lots of taxes. And in Greece, there is poverty. In Italy, corruption. So everything is falling like dominoes. And when we talk about institutional money, we're talking about billions and billions dollars. The power of institutions is immense. And they exercise this power through the bond market. That's the market movers. When a country goes bankrupt, basically everything is lost. So the bond market really affects you, and affects you in more ways than you can think. So the next element that drives the market as well is the gold and the silver. Here we can see the gold chart that is in a recent bull run. So gold and silver is real money. It's real money because you cannot print it like the fiat currency, like the euro or the dollar, or you cannot counterfeit gold, not even the alchemists. Mining gold takes a lot of effort, energy, human resources, and machinery just to get a piece of gold. It has been valuable for thousands of years. So gold and silver are real money. So they are in a long bull run because of the dollar is weaker. That means that you can buy more things as the Federal Reserve debase the currency by issuing more dollars. And basically gold and silver are a barometer of our economy. Uh, when they go to the upside, that means that something is going on and something is wrong, like in 2008, right? And now, of course, something is worst, and it's basically it is expected that it's the longer bull run in the last 50 years. They're again a hedge against inflation, and it's a safe haven asset. And gold, for historical reasons, have prevailed as the best performing asset. It will never lose value. For example, there are many currencies that basically don't exist anymore. We can see many empires rise and fall, like the Roman Empire, the Ottoman Empire, and so on. And all currencies have died. But of course, gold, even in biblical times, we can hear about gold. Many other empires die, and gold still has some value. So, some examples of currencies that have died recently are Spanish pesetas, reales during colonial times, the Deutsche Mark, the Italian lira. Times are changing now. We have blockchain, technology, cryptocurrencies, and an overcapacity in our industry. That's why we have to talk about technology. The technology, it's basically one of the biggest market forces of all in the 21st century. And of course, having a strong industry, like it goes as a second level of importance today in an economy, because we're not in the industrial era anymore. We're in the information and technological revolution with big data, and there's like information all around. And information is the most powerful market of all today that generates billions every year. You can be president if you have the information. You can rule the world basically if you know all the information about everyone. Algorithms and artificial intelligence are basically the market movers today. As information is a more powerful market that generates billions of dollars every year, companies like Amazon, Facebook, Tencent, Alphabet, Baidu, Zalando, and so on are a magnet of currency and cash generation. Now, the housing market. The housing market affects as well us because it's a bank and institutional business. It's created for them. Of course, there's like lots of people that have make a business out of it, creating lots of cash flow, but not everyone is successful here. It is a bank, an institutional business, our fractional reserve system. They needed a housing market bubble to create more credit. So an underlying asset serves as a security to get more credit and leverage the economy. But the housing market popped in 2008, and it was paid by the central banks passing the liability to taxpayers and savers, making a sovereign debt. And sovereign debt is the biggest bubble of all. That's why the bond market, it's telling us, it's screaming us trouble. But we are in a nation state international order. So as long as a weak nation states like Zimbabwe or Venezuela, whatever, can survive and keep sovereign, they can pay for everything priced in their own currency. They can buy it all as long as there is trust. Housing market is the bank business and is the trust in our economy. As long as private property is protected, there is hope. Of course, then we have the trust market. So if there is no trust, no religion, no belief that things will go better, the market will crumble like a house of cards. And of course, we are humans that cooperate and build our own realities and stories to survive and keep peace. We create imagined realities like fiat currencies, and trust is everything, so be careful on what you trust. Societies create the stories that they need throughout history, and the value of money is one of them. And why? If you put 100 euros and two bananas in front of a chimpanzee, even them will take the bananas, but we will choose the opposite. And this is because we trust. It's not because it has value on it. This is it. The trust market, it's a very powerful thing. So right now, in this century, where is the power shifting? Here I have a chart of the net international investment position. And you can see who is the net creditor and who is a net debtor. So this is the value of the net international investment position, is the value of foreign assets owned by private and public sector of a country minus the value of domestic assets owned by foreigners. And it's a sum of past current account deficits or surpluses adjusted for regular valuation changes, and the NIP to GDP ratio, which is this, it's a gauge of the credit worthiness of a country. That's why investors look at this chart. The more negative the net international investment position to GDP, the more the country becomes vulnerable to volatility in international financial markets. And there's a range of external liabilities in the EU in this case, and it's very wide. And the risk of financial sustainability remains high in many member states. As you can see, everything is orange now, except Germany and Austria. But the rest of the countries that are basically in orange, they're not trustworthiness anymore. The power is shifting to Asia. And times are changing. So, and not underestimate these markets because they affect you in reality more directly than you think. Monitor the health of these elements that drive the market forces, and you see what drives the economy, and you can make some investment decision. It's time to stop investing in the US market, and it's time to start shifting as well your money to these markets because, well, times are different now. Okay, this is everything. Thank you so much for listening. Don't forget to subscribe to the channel, and see you next time.